Hey everybody, so today we are going to do an analysis of Peloton as a company, and we're going to go over why the stock is dropping and what the company should do next. So why is the stock dropping? Here's a brief history of the stock price of Peloton. In August of 2020, Peloton was on the rise. The pandemic was in full swing, and the stock market was beginning to shrug off the plunge of March 2020. Peloton's brand still appeared to maintain its uniqueness from its competitors. It was trendy and a darling of Wall Street. In December 2020, the stock price approached its peak as the pandemic was hitting the second wave and home exercise skyrocketed. In August 2021, the stock price dropped as the pandemic's effects had lessened. Peloton also issued a recall for its treadmills after a child's death and multiple injuries earlier in the year. Product prices were also reduced and earning estimates were lowered. During the January 19th to 20th, 2022 timeframe, the stock price dropped significantly as a result of decreased demand, price increases, announcements of cost cutting, and potential production slowdowns or stoppages. Here's a look at some of the financials taken from the 10Ks and the 10Qs that help paint a picture of why the stock may be dropping. The rate of revenue growth has severely slowed from over 100% year over year from year-end June 2020 to year-end June 2021 to only 6% from quarter-ended September 2020 to quarter-ended September 2021. In the 3-month period ended September 30th, Peloton onboarded about 161,000 connected fitness subscribers, the lowest net addition in 8 quarters. Revenue grew 6% year over year compared with a 250% increase in the same quarter in 2020. Equally troubling is that gross margin has decreased in dollars despite sales growth, and also decreased as a percentage of revenue. Further, operating expenses, which are overhead costs, jumped from 34% of revenue in the quarter ended September 2020 to 77% of revenue in the quarter ended September 2021. Increases were largely due to increased sales and marketing spending, as well as system implementation and integration costs. In dollars, it jumped almost 140%. In November 2021, Peloton reduced the financial guidance estimates for revenue and earnings per share from previous estimates, sending Peloton shares to its biggest decline ever at the time. As per an article by CNBC, Peloton also at this time implemented a hiring freeze. In another article by CNBC on January 19, 2022, it showed that McKinsey & Company Consulting were hired to study cost cutting at Peloton. Peloton is now expected to raise prices on the bike and the tread connected fitness products as much as 14 to 17% to cover delivery and assembly costs. These are products whose prices Peloton previously reduced to be competitive per their June 30th, 2021 10K. Peloton's ability to increase prices without impacting the number of units sold in an increasingly competitive space can't be a given. The potential trickle-down effect of lower unit sales would be lower than estimated profitable subscriber revenue, which is intertwined with sales of connected fitness units. On January 20th, 2022, it was reported Peloton will halt production of bikes and treadmills due to decreased demand as traditional gyms are no longer in severe pandemic lockdown. In my opinion, the value of the $420 million pre-core acquisition and a potential $400 million related to an investment in U.S. domestic production facilities comes into question. After reports of Peloton halting production, the CEO, John Foley, released a statement saying that the reports were false, but stated the company is right-sizing production in response to seasonal demand curves and that we are resetting our production levels for sustainable growth, which I understand to mean, at the very least, Peloton is reducing production, especially since inventories grew by over nearly 700 million from 2020 to 2021 as per Peloton's 10K. And what do you do when you have too much inventory and not enough demand? You right size production. All of these roads and concerns lead us to cash flow, current and forecasted, per share, and risk. Cash flow and risk are the main components of company valuation and stock price. When earnings guidance is reduced, the stock price drops because earnings are a layman's substitute for cash flow. When the downward revised earnings guidance is still uncertain, the risk meter jumps into the red danger zone and analysts panic. In terms of Peloton's valuation, both cash flow and risk quantification for Peloton are at the height of negative uncertainty for many reasons. A reliable valuation is hard to calculate. Here are some examples of potential negative cash flow and risk. Dropping demand, price uncertainty, rising inventories while customer deposits decrease, production stoppages or right sizing, unused recently purchased expensive capacity like Precor, reliance on showrooms and malls as malls continue to suffer due to the ever-growing monster of Amazon, reliance on intellectual property or patents while also dependent on Asian manufacturing. What could possibly go wrong with that combination? Peloton may be experiencing also a loss of brand appeal if fitness hardware reverts back to commodity status. Peloton was one of the first to enter the interactive at-home fitness movement and therefore had differentiation. But now the hardware has been reduced to commodity status, competing on price because of competitors entering the market offering a similar product. Examples of competitors include Nordic Track, Proform, and Echelon. These are just a few places where you can smell the smoke of risk. And where there's smoke, there's probably a management team systemically cashing in their options. Not saying that there's insider trading, but now management has less skin in the game than they did previously. So what can Peloton do next to turn around its fortune? In terms of a sales and offering strategy, first, they can clarify their online and product delivery strategy for sales and marketing for both connected fitness products and subscriptions. Now, I'm a doctor of physical therapy. I have worked with many different athletes, including triathletes and amputees. I was a high school All-American and Division I collegiate runner and remain a competitive runner on the local level. During June and July of 2020, I developed a comprehensive content offering related to telehealth physical therapy and rehabilitation that I sent in a letter to CEO John Foley in July 2020 as an offer to expand Peloton's revenue. The content I developed would utilize Peloton's connected fitness products and subscription software. Not only did I want to include injury prevention and rehabilitation content with individual and group offerings, but also introduce racing and competition to Peloton's offerings. To date, I have not received a response. Now, Peloton has added yoga and boxing as new content offerings. Now it's time to keep expanding and differentiating themselves from their competition further. Don't go the way of commodity computer hardware dinosaurs Compaq, Wang, DEC, Sun Micro, Data General, etc. Be software content driven to pull hardware sales through. Be Apple or Microsoft. Let it be known I like Peloton. I have used their bike on multiple occasions and believe they have a quality product. But as a company, they can be so much more. Peloton can also address how they measure the company's success with metrics. In terms of metrics management and measures of success, currently, management uses churn metrics for subscription revenue, which relates to people who have left recently. I'm not sure how helpful this is. More sophisticated metrics could be length of stay and related retention metrics. For example, stratified length of stay metrics open doors to understanding the startup and exit costs of subscriptions, as well as length of stay, profitability, break even, and sweet spots. How long have current subscribers been with us? What is the percent of how many subscribers here a year ago who are still here today? How long were subscribers with us who left, and place them in buckets of 1 month, 3 months, 6, 9, 12 months, 2, 3 years, etc., and put it in context of the life of the related equipment used. Then measure efforts to recapture lost subscribers. Also use subscriber metrics, gross new, gross lost, and net change by week, month, quarter. Also, percent growth metrics, net subscribers divided by prior month, quarter, and year membership. Peloton should next measure actions within its process chains. They should develop the transaction chain, as in how do collateral and ads result in number of inquiries, which result in number of person-to-person discussions, which result in how many number of trials, or which result in number of showroom visits, which then results in number of connected fitness purchases, or which result in number of new subscriptions. Then they should develop the relationship chain culture, similar to banks who want multiple relationships with the same depositor and customer. For example, mortgages, savings accounts, checking accounts, investments, debit card, credit card, etc. Offer customers level of discounts based on the number of relationships, and then use relationship metrics per hardware purchaser and per content subscriber. Alright, so that's my analysis of Peloton and what I think they can do to turn around the company. And remember, I'm not a financial advisor. I'm a physical therapist. This is not investment advice, and this is intended for entertainment purposes only. If you'd like me to post any of the links where I obtain my information, please comment below. And if you like the content and want to see more videos like this, please like the video and subscribe to the channel. Take care. And to John Foley and the other fitness companies, I'm available. Email in the description.